Imagine losing your entire life savings to a sophisticated financial scam, only to realize the federal government expects you to pay taxes on that stolen money. This is the brutal reality of the current tax code, a legacy of the 2017 tax reforms that stripped away personal theft loss deductions. But a major shift is unfolding in Washington right now. A new bipartisan bill in Congress aims to retroactively restore these critical tax deductions, fundamentally altering the liability landscape for wealth management and tax advisory giants. For platforms like Intuit and H&R Block, this policy pivot could trigger a massive wave of tax refilings and complex advisory demands. To understand how these policy shifts translate into corporate earnings, we have to look closely at the structural moats of the tax preparation sector. Intuit stands at the very center of this ecosystem. By integrating advanced software solutions with direct access to human tax professionals, the company has built an incredibly sticky consumer and small business ecosystem. Their core value proposition relies on translating complex, fast-moving tax codes into seamless digital workflows. When tax rules become more complicated, the demand for Intuit's automated platform spikes, showing why regulatory complexity is actually a long-term business driver. But the digital space is only one part of this market narrative. H&R Block offers a highly resilient hybrid model, combining physical retail offices with digital tax products to capture a highly loyal consumer segment. At the same time, major financial custodians like Charles Schwab play a critical role in high-net-worth wealth protection and asset custody. These platforms do not just file tax returns, they protect and manage trillions of dollars in client assets. When legislation shifts the burden of fraud and theft losses, these institutions must rapidly adapt their advisory strategies to preserve client wealth. That structural demand shows up clearly when we analyze the quarterly financial performance of these industry giants. Despite highly volatile macroeconomic conditions, tax software and wealth management firms continue to demonstrate incredible revenue resilience. For instance, Intuit's steady double-digit revenue growth highlights the inelastic nature of tax compliance software. People and businesses must file taxes regardless of the broader economic backdrop. Similarly, H&R Block's recent quarterly metrics reveal strong pricing power, proving that consumers are willing to pay a premium for professional assistance in navigating uncertain tax landscapes. Here is where the margin metrics become interesting. Operating margins across the tax technology and wealth advisory sectors are experiencing unique structural shifts. Software-led platforms enjoy exceptional gross margins, often exceeding 80%, which provides a massive buffer against inflationary wage pressures. However, these firms are also reinvesting heavily in artificial intelligence to automate complex tax scenarios. For Charles Schwab, net interest margins remain a core focal point for institutional investors, as asset management fees and transactional cash flows face pressure from shifting interest rate environments. The next signal comes from management's capital allocation strategies. Executives at Intuit are aggressively pivoting toward AI-powered assistant tools, aiming to reduce the cost to serve while increasing customer retention. During recent corporate presentations, leadership emphasized that their proprietary financial data models are key differentiators. By leveraging machine learning, they can identify tax-saving opportunities that traditional systems might miss. This capital allocation strategy is designed to transform tax preparation from a seasonal chore into a continuous, year-round wealth advisory relationship. At the same time, corporate leadership teams are closely monitoring the legislative halls in Washington. H&R Block's management has historically adapted its operational footprint to match major policy changes, scaling their network of remote professionals to handle complex regulatory shifts. Both firms are highly active in working with policy frameworks to ensure their systems are ready for any retroactive tax relief bills. If Congress passes the new theft loss deductions, these management teams are prepared to deploy targeted marketing and tools to help millions of eligible taxpayers recover lost funds. But to fully understand this development, we must look at the broader industry context. The scale of sophisticated financial fraud has reached historic highs, with retail investors losing billions annually to complex online schemes. Under current law, those stolen assets are essentially taxed as realized income if the victim cannot deduct the loss. This creates a devastating double loss scenario. The proposed legislation would finally correct this structural imbalance, creating a massive wave of demand for tax professionals who can navigate complex retroactive claims and restructure damaged investment portfolios. This shifting regulatory tide represents a major structural tailwind for the entire financial services industry. When tax codes undergo significant adjustments, it naturally drives individuals away from self-filing and toward professional platforms. Historically, whenever major tax relief bills are introduced, advisory volumes experience a sustained multi-year lift. This dynamic highlights why wealth management and tax prep companies are often viewed as excellent defensive hedges during times of policy uncertainty, as their services become highly essential tools for capital preservation. That leads us to a bigger question regarding terminal risk. For wealth custodians and digital tax networks, cybersecurity and system integrity are the absolute ultimate vulnerabilities. A single major data breach could destroy decades of brand equity and lead to catastrophic regulatory penalties. At the same time, as financial scams become more advanced, these platforms must spend heavily on cyber defense to protect user data. For Charles Schwab and Intuit, rising operational expenditures related to security and fraud prevention represent a persistent drag on operating margins that investors cannot ignore. Another key structural headwind is the push for direct government-sponsored filing platforms. Initiatives like the IRS Direct File system pose a direct competitive threat to commercial tax software. While this free alternative is currently limited in scope, any expansion could pressure the retail pricing power of Intuit and H&R Block. To defend their market share, these companies must continuously prove their value by offering advanced capabilities, such as automated handling of complex deductions and specialized support for victims of financial fraud. This brings us to a critical valuation reassessment. Modern tax platforms and wealth custodians are trading at premium valuations compared to historical sector averages. Investors are paying a premium for their defensive qualities, stable recurring revenue models, and significant exposure to structural growth drivers. If Washington successfully restores the theft loss deduction, it could trigger a meaningful revision in forward earnings visibility for these firms, as millions of retail investors seek professional help to reclaim past losses and secure their portfolios. Looking out over a multi-year horizon, the structural investment thesis for wealth protection and tax compliance remains highly compelling. As wealth transfer dynamics accelerate and financial regulations grow more intricate, the demand for sophisticated advisory platforms will only rise. Companies that successfully combine automated scale with highly personalized financial guidance are uniquely positioned to capture this long-term shift. They represent high-quality compounders capable of delivering steady capital appreciation even during periods of macroeconomic distress. Taking a tactical look at the current market setup, we are placing Intuit on our breakout watch list. The stock has been consolidating below overhead resistance, showing strong relative strength as positive volatility begins to expand. Meanwhile, we view H&R Block as a solid hold, while keeping Charles Schwab under close observation for capital rotation opportunities as net interest margins stabilize. These positions offer a balanced mix of defensive insulation and exposure to major regulatory tailwinds in a highly uncertain market. This potential policy change serves as a reminder that tax laws and wealth preservation are always evolving. Staying ahead of these shifts is what separates retail traders from sophisticated portfolio managers. To track these long-term macro trends and get deep corporate analyses, subscribe to SR Money News. Let us know in the comments how you are protecting your portfolio against rising systemic risks. We will see you in the next analysis.